On Wednesday, the Dow jumped 1,312 points. The S&P 500 gained 2.51%. The Nasdaq closed up 2.8%. Markets posted their best single session in months, and at the exact same moment, only 4 oil tankers transited the Strait of Hormuz. On a normal day, that waterway sees 100. The ceasefire was real. The oil flow was not. President Trump announced a 2-week pause in U.S. strikes on Iran late Tuesday, contingent on Iran reopening the strait. Markets treated the announcement as delivery. Oil fell 15%, with WTI crude dropping to $96 a barrel from a war peak near 119. Airlines surged double digits. United Airlines gained more than 7%. Carnival cruise lines jumped more than 10%. Energy stocks collapsed in a mirror image. Exxon Mobil dropped more than 6%. APA shed more than 11%. What markets priced was a Strait of Hormuz reopened. What actually happened was a declaration that it would reopen. Those are not the same thing. S&P Global Market Intelligence tracked 4 tanker transits on Wednesday, the day of the rally. Tanker operators and shipping insurers require security clearance, verified passage authority, and updated war risk pricing before moving cargo through a contested waterway. The CEO of United Refining told Fox Business that ships still needed permission from Iranian authorities before transiting. That process takes days, sometimes weeks. The physical oil that would normalize energy prices had not moved. The market acted as if it had.
The market's first take on Wednesday was structurally identical to a pattern seen before. Trump sets a deadline, markets price catastrophe. Trump pauses, markets price relief. Analysts on Wall Street have given this a name, the taco trade, shorthand for Trump always chickens out. The same sequence played out during Liberation Day tariffs in 2025, when the S&P 500 dropped nearly 20% before the reversal. Relief rallies on that trade averaged 8 to 12% in the initial session. The problem is that this is not a tariff reversal. A tariff can be lifted by executive order. It takes effect the same day. Reopening the Strait of Hormuz requires Iran to physically authorize tanker passage, insurers to reprice war risk coverage, operators to reroute vessels, and importing nations to secure clearance. The Iranian parliament speaker, Mohammad Bagher Ghalibaf, said publicly on Wednesday that 3 clauses of the ceasefire framework had already been violated before negotiations had even begun. He cited continued Israeli strikes in Lebanon, a drone shot down over Iran's Fars province, and a dispute over uranium enrichment rights. Markets barely moved on that statement. Crude ticked up slightly, stocks fell only 0.3%. The market had made its call on the ceasefire and was not revising it. But the Fed minutes released the same day told a different story. Officials meeting in March had flagged that a prolonged conflict could push inflation persistently above 2% or alternatively crush consumer spending enough to warrant rate cuts. The Cleveland Fed estimated March inflation at 3.25% year-over-year. Urea fertilizer prices rose 35% in March alone. National average gasoline hit $4.12 per gallon, up 41% from $2.92 before the conflict began. None of that reverses on a declaration. It reverses when oil actually moves. Wednesday's session priced in a world where those numbers are already falling. They are not.
The correct read of Wednesday is this. Markets priced a best-case scenario in a single session before any of the physical conditions for that scenario were confirmed. The Dow is now at 47,909. The S&P 500 is at 6,782. Those levels embed an assumption that oil normalizes, the Fed gains room to cut, and the energy inflation shock reverses over the next several weeks. If that assumption proves right, if tanker traffic reaches 50 or more daily transits by next week, Friday's CPI comes in below 3.2%, and Islamabad talks on Saturday produce a framework both sides accept, the rally has a foundation. Rate cut probability, which jumped from 14% to over 30% in a single session per CME FedWatch, would hold or increase. The rotation from energy into tech and consumer names extends. But if the tanker count stays in single digits through the weekend, the physical oil supply that markets are pricing does not exist. Energy-driven inflation stays elevated. Friday's CPI, the first full read on March, covering the period when oil was above $110, could print above 3.2%. Forcing a rapid repricing of rate cut odds back toward zero. Cleveland Fed President Beth Hammack has already said publicly that rate hikes remain possible if inflation stays persistently above 2%. The weight of evidence suggests the rally is pricing a resolution that is more fragile than the headline implies. Lebanon is not covered by the ceasefire. Israel conducted more than 100 strikes on Hezbollah sites on Wednesday while the truce was being celebrated. Iran's foreign minister said explicitly that the U.S. must choose between a ceasefire and continuing to support Israeli strikes. Those two positions are not reconcilable in a 2-week window. Meta Platforms rallying 6.5% on its Muse Spark AI debut is a real development. Morgan Stanley's Bitcoin ETF launching in the top 1% of all ETF debuts is a real development. But both of those are being carried by a macro tailwind, oil down 15%, that has not yet cleared its first physical test. The verification number is not oil price. It is the daily tanker count in the Strait of Hormuz. If that number reaches 30 by Friday, the market's read is becoming real. If it stays below 10, the rally is running ahead of the facts. Friday CPI at 8:30 a.m. Eastern is the first confirmation point. The ceasefire is 2 weeks old and already disputed. The oil is not moving yet.